If you think day trading is just sitting in front of a screen, clicking buy and sell, and watching money roll in, I need to stop you right there. Before I ever placed my first real trade, I thought speed meant skill and confidence meant profit. I thought if I studied charts, followed a few successful traders online, and kept my emotions in check, I could figure it out quickly. What I didn't realize is that day trading doesn't just test your strategy. It tests your patience, your discipline, your psychology, and sometimes your entire identity. The market has a way of humbling people who think they can outsmart it. I wish someone had sat me down early and explained the realities clearly, not with hype or promises, but with honesty. Because once you step into day trading, you're not just learning a skill. You're entering an environment where small mistakes cost real money, and confidence without preparation can disappear in a single session. When I started, I assumed more trades meant more opportunities to make money. That sounds logical on the surface. If the market moves all day, why not take advantage of every move? But what I learned quickly is that overtrading is one of the fastest ways to lose money. The more I traded, the more I paid in fees and the more mistakes I made. Even with low commissions, spreads, and slippage add up. Slippage happens when the price you expect isn't the price you get, especially during fast market movements. It might seem small, but over time it can destroy consistency. Professional traders often take fewer trades than beginners. They wait for setups that meet strict criteria instead of reacting to every price movement. I used to think sitting out meant missing opportunities. Now I understand that waiting is often the best position you can take. Another thing I wish I knew earlier is how much psychology matters. Everyone says trading is emotional, but you don't really understand that until you're in a trade watching your money fluctuate in real time. Fear makes you close winning trades too early. Greed makes you hold losing trades too long. After a loss, the urge to immediately win it back can be overwhelming. This is called revenge trading, and it's dangerous because it pushes you to take low-quality trades just to feel in control again. The market doesn't care how you feel. It doesn't know your last trade lost money or that you're trying to recover. Successful traders build systems to protect themselves from their own impulses. That might mean setting strict daily loss limits or stepping away after a losing streak. It sounds simple, but sticking to those rules when emotions are high is harder than any chart pattern. I also underestimated how long it takes to become consistently profitable. Social media is full of screenshots showing big wins, but it rarely shows the months or years of losses and learning behind them. Many professional traders spend years practicing before they ever rely on trading as income. Some studies and brokerage data suggest a large percentage of retail day traders lose money over time, especially in their first year. That doesn't mean success is impossible, but it does mean expectations need to be realistic. Treating day trading like a quick way to make money is one of the most common mistakes beginners make. It's more like learning a complex profession where experience matters as much as knowledge. Risk management is something I heard about early but didn't fully respect until I felt the consequences. I thought if I found the right strategy, risk wouldn't matter as much. But even the best strategies have losing trades. Risk management is what keeps those losses from becoming catastrophic. Many traders risk only a small percentage of their account on each trade. That way, one bad decision doesn't wipe out weeks or months of progress. Stop losses are a key part of this. They automatically close a trade if the price moves against you beyond a certain point. At first, I hated using stop losses because I didn't want to accept losses. Ironically, avoiding small losses led to bigger ones. Accepting that losses are part of the process is one of the hardest mental shifts in trading. Another lesson I wish I knew is that the market environment changes constantly. A strategy that works well in a trending market might fail in a sideways one. Volatility can increase or decrease based on economic news, global events, or shifts in investor sentiment. This means you can't just learn one setup and expect it to work forever. You have to adapt. That doesn't mean constantly switching strategies, but it does mean understanding the conditions where your strategy performs best. For example, momentum trading works better when there's strong movement in volume. In quieter markets, those same setups might produce false signals. Learning to read the broader context of the market is just as important as reading individual charts. I also didn't realize how physically and mentally draining day trading can be. Sitting in front of screens for hours requires intense focus. You're processing information quickly, making decisions under pressure, and managing emotions all at once. It can be exhausting, especially in volatile markets. Breaks aren't just helpful, they're necessary. Stepping away after a stressful session can prevent impulsive decisions. Some traders limit their trading hours to avoid burnout. Others have routines that include exercise, proper sleep, and time away from screens. Treating trading like a professional activity rather than a casual hobby makes a big difference in performance and well-being. Technology plays a bigger role than I expected to. Reliable internet, fast execution, and a stable trading platform are essential. A delay of even a second can affect the outcome of a trade in fast-moving markets. Data feeds need to be accurate and timely. Some traders use multiple monitors to track charts, news, and order flow simultaneously. While you don't need the most expensive setup to start, understanding the importance of reliable tools is crucial. Technical issues during a trade can be stressful and costly. Testing your platform and understanding how orders work before risking real money is something I wish I had taken more seriously. Another reality is that not every day is a trading day. Sometimes the best move is not trading at all. If the market is unpredictable or if you're not in the right mental state, forcing trades can lead to losses. Professional traders often have days where they take no trades because nothing meets their criteria. Beginners often feel the need to trade every day to make progress. But progress in trading comes from quality decisions, not constant activity. Learning to accept slow days and quiet markets is part of becoming disciplined. I also learned that education doesn't stop once you start trading. The market evolves, and so should you. Keeping a trading journal can help track what works and what doesn't. Writing down the reasons for entering and exiting trades, as well as your emotional state, can reveal patterns over time. Reviewing trades regularly helps identify mistakes and strengths. Many successful traders emphasize continuous learning. That might involve studying charts, reading about market behavior, or analyzing past trades. Improvement comes from reflection and adjustment. Another thing I wish I understood is the impact of news and economic events. Major announcements like interest rate decisions, employment reports, or geopolitical developments can move markets quickly. Trading during these events can be risky because price swings are unpredictable. Some traders avoid trading during high-impact news altogether. Others specialize in it but prepare carefully. Understanding when these events occur and how they might affect markets is important for planning trades and managing risk. Capital requirements are also more significant than I expected. Starting with too little money can create pressure to take bigger risks. When your account is small, the temptation to risk more per trade to see meaningful gains is strong, but that increases the chance of large losses. Having enough capital to trade responsibly and absorb losses without emotional stress is important. Trading with money you can't afford to lose adds unnecessary pressure and can lead to poor decisions. Financial stability outside of trading helps maintain a clearer mindset. Another lesson is that consistency matters more than occasional big wins. A single large profitable trade can feel amazing, but if it's followed by several losses, it doesn't build long-term success. Consistent small gains with controlled losses are more sustainable. This requires patience and discipline. It also requires letting go of the desire for constant excitement. Many successful traders describe trading as boring when done correctly. It's about following a plan rather than chasing thrills. Community can be helpful, but it can also be misleading. Online trading communities often highlight wins more than losses. Seeing others post profits can create unrealistic expectations or pressure to match their performance. It's important to remember that you don't see their full trading history, risk levels, or losses. Learning from others is valuable, but comparing your progress to theirs can be harmful. Focus on your own development and strategy. I also wish I knew that taking breaks from trading is sometimes necessary. After a series of losses or a stressful period, stepping back can help reset your mindset. The market will always be there. Returning with a clearer perspective can improve decision-making. Pushing through emotional exhaustion often leads to mistakes. Rest is part of the process. Another important reality is that day trading isn't the only way to participate in markets. Some people discover they prefer swing trading or long-term investing. Day trading requires time, focus, and a specific personality type. It suits people who can handle fast decisions and emotional swings. Others may perform better with longer time frames where decisions are less rushed. Exploring different approaches can help you find what fits best. Taxes and regulations are another area I didn't think about enough at the start. Trading profits are often taxable, and the rules vary by country. Keeping accurate records of trades is essential. Understanding how taxes apply can prevent surprises later. Some regions also have specific rules for day traders, including capital requirements or pattern trading regulations. Being aware of these factors helps avoid complications. I also learned that confidence needs to be earned gradually. Early wins can create overconfidence, leading to larger risks. Early losses can create fear and hesitation. Building confidence through consistent practice and disciplined risk management is more reliable. Paper trading, or simulated trading, can help practice strategies without risking real money. While it doesn't replicate all the emotions of real trading, it's useful for learning how platforms and strategies work. One of the most valuable lessons is accepting uncertainty. No strategy guarantees success on every trade. The goal is to manage probabilities, not predict the future with certainty. Even well-researched trades can fail. Accepting this reduces emotional stress and helps maintain discipline. It also prevents the urge to constantly search for a perfect strategy that doesn't exist. Another insight is the importance of having a clear plan before entering a trade. Knowing where you'll enter, where you'll exit if the trade goes against you, and where you'll take profit removes guesswork. Without a plan, decisions become reactive and emotional. Planning trades in advance creates structure and reduces impulsive actions. Patience is perhaps the most underrated skill in day trading. Waiting for the right setup, waiting for confirmation, and waiting for your plan to play out requires restraint. Acting too quickly often leads to mistakes. Patience also applies to growth. Becoming a skilled trader takes time. Rushing the process can be costly. I also wish I knew that losses don't define you as a trader. Everyone experiences them. What matters is how you respond. Learning from losses and adjusting strategies is part of improvement. Dwelling on them emotionally can lead to poor decisions. Viewing losses as feedback rather than failure helps maintain perspective. Another thing I learned is that lifestyle balance matters. When trading becomes the only focus, it can create stress and isolation. Maintaining hobbies, relationships, and activities outside of trading supports mental health. A balanced life helps maintain emotional stability, which improves trading decisions. Finally, I realized that day trading is a personal journey. Advice from others can guide you, but your experience will be unique. Your risk tolerance, schedule, and goals shape your approach. Finding a method that fits your personality and lifestyle is key. There's no universal formula for success. If I could go back and talk to my past self before that first trade, I wouldn't tell them to avoid trading. I would tell them to prepare differently. I would emphasize patience, discipline, and realistic expectations. I would explain that success in trading isn't about being right all the time. It's about managing risk, learning continuously, and staying emotionally balanced. Day trading can be rewarding, but it demands respect. It rewards preparation and punishes impulsiveness. Understanding these realities early doesn't guarantee success, but it makes the journey far more sustainable.